Tomorrow night, Friday, March 14th at 4 p.m. Eastern, the silver market closes and does not reopen until Sunday evening at 6 p.m. That is 50 hours of complete stillness. No trading, no exits, no adjustments. During those 50 hours, 3 major developments could move silver anywhere between $10 and $20 in either direction before you can touch your position Monday morning. The FOMC meeting is scheduled for Tuesday, March 18th. The final March delivery settlement window closes next week. Shanghai, which has been paying $13 above spot for physical silver, while New York trades at $87, opens Saturday morning while you're asleep. If your entire net worth is sitting in silver and you go into this weekend without taking the specific steps outlined below, you are gambling your financial future on a 50-hour window where you have absolutely no control. The framework I am about to give you protects your wealth through this weekend, regardless of which direction Monday opens. Let me put real numbers to what you are facing, because abstract risk feels manageable until you see exact dollar amounts tied to your specific position. If you hold 1,000 ounces of silver purchased at an average cost of $28, your total investment was $28,000. At Thursday's price of approximately $87.65, your position is currently worth $87,650, giving you $59,650 in unrealized gains. That number feels incredible. It represents years of conviction finally paying off, but that number is completely imaginary until you convert some portion of it into realized gains sitting in a bank account rather than locked inside a metal safe. The crash between January 29th and February 14th took silver from $121 down to $63.90, a 47.2% decline in just 17 calendar days. On a 1,000-ounce position, that crash would have dropped your value from $121,000 to $63,900, a loss of $100 in under 3 weeks. Your position would have been worth less than the price of a mid-range sedan. If your entire net worth was in silver during that crash, you watched more than half your wealth vanish in 2.5 weeks. If rent was due on day 5, you faced a choice between selling into crash prices or missing your payment. If a medical emergency hit on day 8, you were forced to liquidate metal into the worst market conditions since the 2020 pandemic panic. You survived that crash by holding, and silver recovered to $87. Your conviction was correct. But surviving once does not guarantee surviving twice, and this particular weekend carries a risk profile unlike any other in the 2026 silver cycle. There are 3 specific reasons you need to understand completely before tomorrow's close. Risk number 1 is the FOMC gap. The Federal Reserve meets Tuesday, March 18th, and the blackout period preventing Fed officials from speaking publicly began this week. No Fed guidance will be available between now and Tuesday's 2 p.m. Eastern announcement. The market is currently pricing a 73% probability of a rate hold and a 27% probability of a rate cut. Wednesday's CPI printed at 2.4% headline and 2.5% core, both in line with expectations. This morning's PPI added another data point the market is still digesting. The Fed has enough data to justify either action. If the Fed cuts rates on Tuesday, silver gaps up $5 to $10 at Monday's reopening because rate cuts weaken the dollar and commodity algorithms instantly buy. If the Fed holds but shifts language toward future cuts, silver rallies $3 to $5 on the dovish interpretation. If the Fed holds with hawkish language, silver drops $5 to $8 as rate cut expectations collapse and the dollar surges. If the Fed surprises with a statement that explicitly rules out cuts for 2026, silver could revisit the $80 level, losing $7 to $0 from current prices. The FOMC outcome is unknown and will not be known until Tuesday at 2 p.m. But the market begins pricing the expected outcome Sunday evening when Globex opens. Traders in Tokyo, Hong Kong, and Singapore will react to weekend news and geopolitical developments by buying or selling silver futures before any American trader can participate. Your 1,000-ounce physical position cannot be adjusted between Friday 4 p.m. and Monday 9:30 a.m. You are locked in for 50 hours while institutional traders adjust continuously. The historical weekend gap risk on FOMC weeks averages 2.8% in silver on $87.65 per ounce. That is $240 per ounce, or $2,450 across 1,000 ounces of risk in either direction. That risk is unavoidable if you hold 100% of your net worth in a single asset through the weekend. Risk number 2 is the Shanghai weekend premium. The Shanghai Gold Exchange opens Saturday morning China time, which is Friday night Eastern time. The Shanghai premium over COMEX is currently $15.75 and expanding at roughly 50 to 60 cents per day. If that premium expands to $16.50 or $17 during Saturday's session, the arbitrage profit from draining COMEX vaults increases, triggering additional delivery notices for March and positioning more contracts for May delivery. Those delivery notices hit the COMEX system Monday morning before the U.S. market opens. If Monday's delivery notices show a spike in standing demand, registered inventory, already at 78.5 million ounces, could drop below 77 million before American traders can react. The Shanghai Saturday session processes approximately 12,000 to 15,000 silver contracts at 5,000 ounces each. That is 60 to 75 million ounces of notional trading in a session where COMEX is closed and cannot provide offsetting liquidity. Saturday's price discovery in Shanghai sets the opening tone for the entire global silver market on Monday. If the Shanghai premium widens to $17 on Saturday, New York opens Monday with algorithms recalculating the arbitrage and accelerating COMEX delivery demands. Your position benefits from higher prices, but the increased volatility means larger intraday swings that will test your psychological endurance. Risk number 3 is the weekend geopolitical wildcard. The Strait of Hormuz is at 5% throughput, and the Pentagon confirmed the most intense strikes yet against Iran on Wednesday night. Trump simultaneously stated the war could end very soon. Two completely contradictory signals. Any weekend development, from a ceasefire announcement to a major Iranian retaliatory strike, could move silver $5 to $15 before you can react Monday morning. A ceasefire would send oil down 20 to 30% in a single session, dropping silver $5 to $8 on reduced safe haven demand and lower inflation expectations. An Iranian strike on Saudi oil infrastructure would push oil above $150 and spike silver $8 to $12 on safe haven panic. Both scenarios are entirely plausible, and both could materialize Saturday or Sunday while you are locked out of the market. The combined risk from FOMC positioning, Shanghai weekend trading, and geopolitical uncertainty creates a potential Monday opening range of $78 to $97. That is a $19 range on 1,000 ounces, a $19,000 swing in either direction. Your entire original $28,000 investment could be wiped out by a Monday morning gap if the worst case materializes. The probability of the worst case is low, perhaps 5 to 8%, but the consequence is catastrophic for someone with 100% concentration. Here's exactly what you do before 4 p.m. Eastern tomorrow. 5 specific actions in order of priority. Each one reduces your weekend risk while preserving your exposure to the upside thesis that brought you into silver. The thesis is correct. The structural deficit is real. The COMEX drain is real. The Shanghai premium is real. This framework is not about abandoning the thesis. It is about surviving long enough to collect on it. Action 1. Sell 15% tomorrow morning for cash. Calculate 15% of your total ounces. On 1,000 ounces, that is 150 ounces. Sell them at market price tomorrow, Friday, before noon. Do not wait for a specific price target. Do not try to time the intraday high. The difference between selling at $87 versus $89 on $150 ounces is only $300. That is $300 of optimization versus the peace of mind of having $13,147 in cash in your bank account by Monday morning, no matter what the market does over the weekend. That cash goes into a money market fund or short duration treasury bills, yielding approximately 4.3%. It does not go into stocks, crypto, or back into silver. It sits as your strategic reserve. This cash serves 3 functions. First, it covers your bills for the next 3 to 4 months without forcing you to sell silver during a correction. Second, it gives you capital to buy additional silver if the market offers you a dip below $80. Third, it eliminates the psychological pressure of knowing that a 20% correction puts your next rent payment at risk. That psychological pressure is the silent killer of concentrated positions because it forces emotional decisions at precisely the moments when rational thinking matters most. Action 2. Place weekend gap orders. If your silver is held in a futures or trading account, place a good till canceled limit buy order at $79 and a good till canceled limit sell order at $96. These orders execute automatically during Sunday evening's Globex session and Monday pre-market without requiring you to be awake. The $79 buy order adds to your position if the market gaps down to the February support level, the same level where institutional buyers defended with 62,000 contracts of volume 2 weeks ago. The $96 sell order takes profit on 10% of your remaining position if the market gaps up through the gamma squeeze trigger level. Both orders convert weekend risk into weekend opportunity. If your silver is physical and cannot be traded electronically, you cannot place gap orders, which is exactly why Action 1 matters so much for physical holders. Your cash position is your gap order. If Monday opens at $79, you deploy the cash to buy physical at the dip. If Monday opens at $96, your 15% cash is safe regardless. Action 3. Establish a minor position. Take 5% of your total silver position value and allocate it to silver mining stocks before Friday's close. Not 5% of your ounces, but 5% of the dollar value. On $87,650 of silver value, that is $4,282 split equally among 3 companies in different jurisdictions. First, Majestic Silver operates primarily in Mexico with the San Dimas and Santa Elena mines, reported record Q4 2025 production of 4.2 million ounces, and is trading at approximately 0.75 times net asset value despite Mexican security risks. Pan American Silver operates across Mexico, Peru, and Canada with record production at their Juanicipio joint venture, and their geographic diversification reduces single-country risk. Hecla Mining operates in the United States and Canada, providing zero emerging market risk with stable permitting and a secure operating environment. The miner position accomplishes 3 things. It keeps your total precious metals exposure at 95% while diversifying from 100% physical into 95% physical plus 5% equity. Mining stocks are liquid. You can sell them in seconds from your phone if you need emergency cash during a correction, whereas physical silver requires finding a dealer, negotiating, shipping, and waiting for payment. In a crisis, the 5% miner position can be liquidated within minutes. Liquidity is survival for concentrated holders. Miners also provide leveraged upside. When silver rises 10%, primary silver miners typically rise 25 to 40% because fixed costs are already covered and additional revenue flows directly to the bottom line. If silver reaches $150, your physical position gains 71%, while your miner position gains 150 to 200%. The 5% allocation to miners at 200% returns generates the same dollar profit as a 10% allocation to physical at 71% returns, the same upside exposure with half the capital commitment, leaving more dry powder for dips. Action 4, calculate your true break-even. Most concentrated silver holders know their average purchase price per ounce, but do not know their true break-even, which must include opportunity cost. If you invested $28,000 into silver 3 years ago, that same $28,000 in a total stock market index fund would be worth approximately $40,000 today, based on the S&P 500's cumulative return over that period. Your true break-even is not $28 per ounce. It is $40,000 divided by 1,000 ounces, which equals $40 per ounce. Your real gain is not $59,650. It is $47,650 because $12,000 of your apparent profit is simply matching what the stock market would have delivered anyway. This calculation changes your exit psychology entirely. If you believe your break-even is $28, you feel wealthy at $87 and resist selling because every sale feels like abandoning a winner. If you know your true break-even is $40, you recognize that your outperformance over the alternative is $47 per ounce, not $59. You are still massively outperforming, but you also recognize that a return to $40 silver, which would require a 54% crash, is not just a paper loss. It would be a return to zero alpha, meaning you would have been better off in an index fund. That recognition is what motivates the risk management framework, because it reminds you that the gains are only real if you protect them. Action 5. Write down your exit rules. This is the most important action and it costs nothing. Before Friday's close, write the following 5 rules on physical paper, not on your phone, not in a notes app, but on paper, and tape them somewhere you will see them every single morning. Rule 1, I sell 20% of my remaining silver if price reaches $115 and holds for 3 consecutive daily closes above that level. Rule 2, I sell another 15% if price reaches $130 on any daily close. Rule 3, I add to my position with cash reserves if price drops below $79. Rule 4, I do not sell any silver below my true break-even of $40, regardless of how frightening the correction looks. Rule 5, I review these rules every Sunday night, and I do not change them during market hours when emotion overrides logic. These rules transform you from a gambler into a systematic investor. They were written when you were calm and rational. They will execute when you're panicked and irrational during a Monday morning gap. The rules do not care about your emotions. They care about math. And math is what protects concentrated positions from the behavioral mistakes that destroy them. The structural thesis remains completely intact. COMEX registered inventory is at 78.5 million ounces and draining at 1.52 million ounces per day, with each registered ounce backing 7.3 paper claims. March deliveries have consumed over 33 million ounces, with 5.89 million more scheduled, and May contracts represent 387 million ounces of paper claims waiting in the pipeline. Shanghai premiums are at $16 and expanding daily. The gold-silver ratio sits at 57 and is compressing at 2.67 points per week. The structural deficit stands at 67 to 142 million ounces for the 6th consecutive year. Chinese export restrictions are permanent. Mexican production is collapsing under cartel violence. The refining chain is broken by nitric acid shortages. Military consumption is permanently destroying silver. Solar demand is inelastic at 194 million ounces. AI demand is accelerating. BlackRock is publicly bullish. Bank of America is targeting $309. Citigroup is targeting $150. The thesis is real, and it is validated daily by every data point coming in. The thesis will likely make you wealthy over the next 12 to 36 months. But the thesis does not protect you from a weekend gap. It does not pay your rent during a 47% correction. It does not stop the CME from raising margins another 36% at 2 a.m. on a Sunday night. The thesis is the reason you hold silver. The framework is the reason you survive holding silver. 15% to cash, gap orders placed, 5% to miners, true break-even calculated, exit rules written on paper, 5 actions, 3 hours to execute before Friday's close. The thesis carries you to generational wealth. The framework ensures you are still holding when it arrives. This weekend is 50 hours of uncertainty standing between you and the FOMC meeting, the Shanghai Premium expansion, and a war with no ceasefire timeline. Do not enter those 50 hours with 100% of your net worth locked in a single asset with zero liquidity and zero protection. Enter them with 80% silver, 5% miners, and 15% cash. Enter them with gap orders that convert volatility into opportunity. Enter them with written rules that prevent the emotional destruction of a thesis that took years to build. Friday at 4 p.m. Eastern is the deadline. After that, you are locked in. The next window to adjust is Sunday at 6 p.m. when futures open. And by then, Shanghai has already traded Saturday, and the geopolitical landscape may have changed entirely. Every minute between now and Friday's close is preparation time. Use it.